Welcome back to Global Power Play, your go-to source for the latest global political news. This is our weekly recap, where we bring you all the biggest stories from the past week, covering key events from the US, Europe, and around the world. Sit back, relax, and let's dive into this week's most important updates. The US and China's trade war has evolved far beyond just tariffs on electronics and agricultural products. It's now deeply embedded in the energy sector, with China making seismic shifts in its oil and natural gas imports. So what's at stake in this high-stakes energy battle? Why is China turning away from the US and pivoting to countries like Canada, Russia, and even Qatar for energy deals? And what does this mean for the global energy market in 2025? Let's dive into the heart of this ongoing conflict and break down what's really happening with China's energy strategy and what the consequences are for both the US and the global economy. The trade war landscape. It all started in 2022 when China and the United States began imposing aggressive tariffs on each other's products. Under the Trump administration, the US aimed to bring Beijing to its knees by targeting Chinese electronics, machinery, and, perhaps most surprisingly, energy. In 2023, when President Biden took office, the situation didn't improve much. The tariffs stayed, with China retaliating against the US by imposing tariffs on crude oil and liquefied natural gas, LNG. Fast forward to 2025, the trade war between the two nations continues to escalate, and energy trade is at the epicenter. The shift away from US oil. In the early years of the trade war, US oil was a hot commodity in China. Affordable American crude oil and LNG helped China close its massive energy deficit. Between 2017 and 2018, the US became one of China's top suppliers of crude oil, with shipments peaking at over 300,000 barrels per day. However, this trend has taken a drastic turn. China has now slashed its oil imports from the US by 90%. The reasons are clear: tariffs ranging from 25% to 30%, coupled with growing geopolitical tensions. According to Bloomberg, China has turned to Canada as its new oil supplier, with imports from Canada hitting historic highs. The shift is not just about economics. Canada offers China a more stable political environment compared to the volatility of US-China relations. China has also been strengthening its energy ties with Russia, particularly since the escalation of the Ukraine conflict. Energy trade in 2025, China's new alliances. In 2025, Canada is making a big splash in the energy market. Chinese state-backed energy companies are now purchasing Canadian oil at record levels. In the past 3 months, China's imports of Canadian crude oil have nearly doubled, as Canadian producers ramp up their oil extraction from the Alberta oil sands. This move is part of China's broader strategy to reduce dependence on the US and diversify its supply chain. Meanwhile, Russia has been providing China with discounted oil, an attractive option due to the ongoing conflict in Ukraine and Western sanctions. Russia's energy exports to China have surged, with Moscow offering crude oil at a discount of $10 to $15 per barrel. The impact on US producers. So what does this mean for US energy producers? With China slashing its oil imports by 90%, according to the US Energy Information Administration, US crude oil exports in 2022 reached 3 million barrels per day, with a significant portion going to China. The role of Canadian oil. Canada has emerged as a critical player in this new energy landscape. With its heavy oil resources in Alberta and a relatively stable political environment, Canada is now seen as a more reliable partner than the US for China's energy needs. In response to this shift, Canadian companies are expanding their production capacities and building new infrastructure, including new terminals and pipelines to increase oil exports to China. This is not just an energy deal, it's also a political move. Canada, which had previously been at odds with China over issues like Huawei and technology restrictions, is now more willing to strengthen its ties with Beijing. For China, this is a strategic decision. By diversifying its energy sources, China is not only reducing its reliance on the US, but also strengthening its political leverage in the global energy market. The global consequences. As China moves away from US energy imports, the implications for global energy markets are enormous. Energy giants like Russia, Saudi Arabia, and OPEC are watching closely as China strengthens its ties with Canada and Russia. The shift in supply chains means that oil and gas prices could fluctuate significantly. For the U.S., the question is, can they recover the lost market share? The answer remains unclear. While U.S. oil companies are trying to find new buyers, the competition is fierce. Europe, which has been increasing its LNG imports due to the Russia-Ukraine crisis, is not necessarily open to U.S. LNG due to price concerns. The U.S. and China's energy trade war shows no signs of slowing down. With China's dramatic shift toward Canadian and Russian oil and gas, the global energy map is undergoing a fundamental transformation. In the short term, the U.S. will continue to feel the economic effects of losing a giant customer like China. However, with both countries locked in this trade war, the question remains, how long will this new equilibrium last, and what will be the ultimate cost to the global economy? As the U.S. energy sector continues to adapt and explore new markets, China's pivot to alternative suppliers shows the growing power of energy in this global tug-of-war. It's clear that energy is not just a commodity, it's a geopolitical weapon, and in this battle, the stakes are higher than ever. Hong Kong has announced a complete suspension of its goods-based postal services to the United States, escalating tensions in the ongoing economic standoff between China and the U.S. The decision, effective from April 27, 2025, is a direct response to a newly imposed 120% tariff by Washington on low-value imports, specifically targeting e-commerce shipments under $800, which were previously exempt under the de minimis rule. This change doesn't just affect businesses. It impacts millions of consumers who frequently buy electronics, fashion, and gadgets online from Asia. If you've placed an order from a Hong Kong-based seller or are expecting a package routed through the city, brace yourself. Delays are just the beginning. A representative from Hong Kong Post stated bluntly that they would not collect tariffs on behalf of the U.S. government, calling the policy exploitative and unreasonable. From now on, only documents, no packages, no goods, will be accepted for mail to the U.S. This marks a dramatic shift for Hong Kong, long regarded as a global logistics and trade hub. And the ramifications go far beyond the postal service. For decades, Hong Kong has played a crucial role in global trade, especially as a re-export gateway for Chinese goods bound for the West. But with these new U.S. tariffs and now Hong Kong's countermeasure, the city's foundational role is under threat. From the business side, the mood is grim. One electronics exporter in Kowloon, Mr. H. Tan Lee, told local media, with shipping costs rising, inspection delays, and now this new tariff wall, our profits are gone before the product even ships. And it's not just small business owners feeling the squeeze. Major cargo airlines operating out of Hong Kong International Airport have already scaled back U.S.-bound freight. Several U.S. companies, including a prominent tech accessories brand, have reportedly paused imports through Hong Kong, seeking alternative sourcing routes through Taiwan or Vietnam. The maritime sector is equally strained. Ships departing from Hong Kong now face extended inspections and additional fees at U.S. ports. This has led to a significant backlog of cargo containers sitting idle, a rare sight in what used to be one of Asia's busiest shipping corridors. Economically, the outlook is stark. Analysts predict that Hong Kong could lose between 35 to 45 billion US dollars in exports this year alone if trade with the US continues to collapse. Around 1 million workers are estimated to be in sectors that depend on US trade, including dock workers, freight handlers, customs agents, and factory workers tied to export manufacturing. Economists warn that a prolonged breakdown could trigger mass layoffs, business closures, and even a recession in the region. And the pain doesn't end there. Hong Kong's financial sector, which prides itself on stability, is watching the developments nervously. Indexes have shown early signs of correction, and foreign funds have begun to trim exposure to Hong Kong-based assets, citing rising geopolitical risk. From a geopolitical standpoint, this crisis is deeply intertwined with Beijing's own strategy. Chinese officials have publicly backed Hong Kong's response, condemning the U.S. for what they call economic aggression. A spokesperson for the Chinese Ministry of Commerce said today, "The United States continues to use trade as a political weapon. Hong Kong's choice is justified and supported." Behind closed doors, there's growing speculation that this postal service suspension was encouraged by Beijing as a show of strength, signaling that economic pressure from Washington will be met with resistance, not retreat. The U.S., for its part, remains firm. A White House trade advisor said this morning, Hong Kong is no longer autonomous from Beijing. The trade privileges once granted were abused. We are correcting that mistake. So what's next? With both sides digging in, a diplomatic breakthrough seems unlikely in the short term. Some observers warn that this postal standoff could become a test case for even broader trade disengagement between the U.S. and China, with Hong Kong caught directly in the middle. Alternatives, such as rerouting goods through third countries, come with high costs and legal risks, and for many businesses, that's simply not viable. Hong Kong now faces a critical 3-month window. If this standoff continues through the summer, the consequences could be irreversible. Job losses, a weakened economy, and increased dependence on Beijing politically and economically. In the end, Hong Kong's suspension of postal goods to the U.S. is more than a logistics update. It's a symbol of a deepening divide in the global economy, a confrontation with roots in politics, power, and identity. Whether this move will serve as a catalyst for compromise or a flashpoint for further escalation remains to be seen. But one thing is clear, this trade route, once a bridge between East and West, now looks more like a battlefield. What happens when tariffs on cars push global markets to their breaking point? In 2025, we're seeing the fallout of protectionist trade policies. Here's what's at stake for the American auto industry, global automakers, and car buyers everywhere. Before we dive in, hit that like button. It really helps our channel, and it makes sure you don't miss out on crucial updates. Now let's get into it. The 2025 tariff update. In the world of global trade, tariffs are a powerful tool. As of April 2025, the United States has imposed a staggering 25% tariff on all cars not made within its borders. That means if a car is made in a foreign country, whether it's China, South Korea, or even Germany, it's now subject to a hefty tax when it enters U.S. markets. However, if it's made in the U.S., no tariff applies. For the American automotive sector, this is both a blessing and a curse. While it's great for local manufacturing, it's wreaking havoc on the global supply chain. The result? Foreign automakers are adjusting their strategies, while American companies are struggling to deal with retaliation from other nations. Just last week, China increased its tariffs on U.S. imports, with duties reaching as high as 150% on some goods, including vehicles. This retaliatory move has rocked U.S. exports, and American car makers are feeling the heat. It's a volatile situation for brands that depend on global markets, especially in China, the world's largest auto market. Ford struggles with China. Take Ford, for example. The iconic American brand just made headlines with a bold move. It has suspended all shipments of U.S.-made vehicles to China. This includes some of its most popular models like the F-150 Raptor and the Mustang. Why? The Chinese government slapped a $150,000 tariff on American-built cars, causing prices to skyrocket. For a consumer in China, a car that normally costs $40,000 in the U.S. is suddenly out of reach. Ford's decision is a response to the retaliatory tariffs, which have essentially shut the door on its ability to compete in the Chinese market. It's a huge blow to the company, considering China was one of Ford's largest and most profitable overseas markets. Ford isn't just freezing exports, it's restructuring its global approach. While it still ships parts to its Chinese factories for assembly, finished vehicles are no longer on the table. This policy change underscores the challenges that American automakers face when operating in an increasingly fragmented global market. The impact on Buick. Ford isn't the only one scrambling. Buick, which had been in the midst of a major comeback, is now facing a tough reality. In the first quarter of 2025, Buick sales were up nearly 40%, driven by popular models like the Encore GX and the Envision. But there's a catch. All these breakout models are made overseas. The Encore GX is built in South Korea, while the Envision comes from China. Under the current tariffs, South Korean-made vehicles are hit with 27.12% duties, and the Chinese-built Envision faces nearly 50% in additional taxes. For Buick, this means prices are about to jump, inventory could slow down, and its momentum could be lost. One auto analyst put it bluntly, if these tariffs continue, Buick might not survive. The U.S. tariffs have thrown a wrench into the recovery of a once struggling brand, and dealers are bracing for the worst. Japan's response. Japan is feeling the pressure too. The Japanese economy relies heavily on auto exports, especially to the U.S., where companies like Toyota, Honda, Nissan, and Subaru sell millions of vehicles each year. But with the 25% tariff now applied, Japanese automakers are scaling back shipments to the U.S. Some are even quietly raising prices to absorb the cost of tariffs. Behind closed doors, Japan's officials are negotiating a trade deal with Washington. In an effort to offset these tariffs, they've proposed a major increase in the purchase of U.S. agricultural products like soybeans and rice. This isn't just about cars anymore. It's about the future of global trade. Washington has not dismissed the idea, and some believe this could be the key to resolving the ongoing trade war. Japan's auto industry remains on edge. The message from Tokyo is clear: negotiate a fair deal or face the economic consequences. The bigger picture. All of this, Ford, Buick, Japan, traces back to one central issue: economic nationalism. This is a strategy where tariffs are not a bargaining chip. They are the endgame. The U.S. government's goal has been to bring more jobs back to America by limiting foreign competition. But the reality is that these tariffs are isolating the U.S. from the global economy, and retaliation is already happening. China, for example, has completely shut down one of the largest overseas markets for American automakers. Exports are plummeting, routes are collapsing, and even U.S.-based factories are starting to feel the pressure. But it doesn't end there. Ford's internal documents suggest that if tariffs continue into the next quarter, price increases on select models are inevitable. This will lead to higher costs for buyers, fewer incentives, and ultimately, lower sales volume. Even American-made cars aren't immune. Many parts for U.S. vehicles, engines, wiring, electronics, are sourced from places like Japan, Mexico, and China. These parts are now subject to tariffs as well, meaning the cost of manufacturing will rise across the board. President Trump recently stated that American farmers are at the front lines of the ongoing trade war with China. The administration is considering subsidies for farmers, but Trump has warned there are no winners in a trade war, and going against the world will only lead to self-isolation. These remarks follow the administration's decision to raise tariffs on Chinese goods, setting off a global ripple effect. Once the backbone of global food production, American farmers now face a staggering collapse in trade stability as tariffs devastate key agricultural markets. Let's begin with soybeans, a crop that used to symbolize U.S. agricultural dominance. Before the trade war, American soybeans were a crucial export to China. However, after Trump imposed a 145% tariff on Chinese goods, China retaliated with a 125% tariff on U.S. soybeans. As a result, soybean sales to China plummeted by over 90%. This has forced many farmers, particularly in Iowa and Illinois, to abandon soy and switch to corn. Despite a slightly broader market, corn is far from a silver bullet. With rising costs for fertilizer and diesel and a flood of new supply pushing down prices, many farmers predict 2025 could be their breaking point. The pork industry is also suffering. Once the third largest supplier of pork to China, the U.S. is now irrelevant in the Chinese market. Retaliatory tariffs have driven the cost of U.S. pork up by over 170%, leading China to turn to Brazil, the EU, and the UK. Although U.S. pork is being redirected to Mexico and the Philippines, these countries cannot absorb the demand once supplied by China. As a result, pork prices have fallen, cold storage is filling up, and layoffs are imminent in the sector. The dairy industry has been hit hard as well. With China imposing a 125% tariff, U.S. dairy exports to China have nearly disappeared. Milk prices are dropping, and processors are warning of potential closures unless new markets are found soon. Meanwhile, feed prices remain high due to supply chain disruptions and avian flu outbreaks. exacerbating the financial strain on dairy farmers. The fruit industry is also facing a crisis. Farmers in Washington and Oregon, who once relied on China as a major buyer, have seen export revenues drop by over 70%. Countries like India have kept tariffs high, and nations like Australia and Japan have banned certain U.S. fruits. Apples are being processed instead of sold fresh. Cherries are being discarded, and pear orchards are left unpicked. In 2025, former President Donald Trump is back in office, and so is the trade war. What began in 2018 has flared up again, affecting businesses, global markets, and political narratives in both Washington and Beijing. But this time, the stakes are even higher. On a new round of tariffs. Since returning to the White House in January, Trump has reignited his hardline stance on China. As of April 2025, the U.S. has slapped tariffs of up to 145% on Chinese imports. This started with a 10% blanket increase on February 1st, followed by steep hikes in early April. In retaliation, China raised tariffs to 125% on key U.S. exports, including agricultural products like soybeans and energy commodities like coal and oil. These moves have sparked fresh fears of a deeper decoupling between the two largest economies. The global fallout. The impact is already being felt across industries. Shipping volumes between China and the U.S. have dropped significantly. Some ports have reported cancellation rates of up to 50%, echoing the COVID-era trade freeze. Retail giants such as Amazon, Walmart, and Target are adjusting their inventories and pricing, while manufacturers are scrambling to find alternative supply chains. Procter & Gamble and PepsiCo have downgraded their earnings forecasts. Even airlines like Delta and United are pulling back financial guidance due to economic volatility. Apple's big move tech giant Apple has announced that by the end of 2026, all iPhones sold in the U.S. will be assembled in India, not China. This major shift aims to insulate Apple from the turbulence of U.S.-China relations and reduce its dependency on Chinese manufacturing. Mixed signals from Washington. While Trump continues to talk tough, some observers say his administration lacks a clear strategy. Negotiations are active one day, frozen the next. The result? Confusion among global investors and uncertainty for American consumers. According to AP News, some White House advisors have warned that overreaching with tariffs could backfire on U.S. businesses, especially during a time when inflation remains a key concern. Ways China claps back online. Meanwhile, on Chinese social media platforms like Weibo and Douyin, Trump is again a favorite target of ridicule. Hashtags like "Wana Trump caved" and "Coward President" have gone viral. Users mock his rhetoric as empty and his strategy as chaotic. One widely shared meme shows Trump swinging a trade war hammer, only to hit himself. National pride runs high, with slogans like "We survived the tariffs" again trending throughout April. Importantly, this mockery often aligns with the Chinese state's messaging. While direct censorship is common in China, posts ridiculing foreign leaders, especially from the U.S., are often left untouched or even amplified. What's next? Despite the nationalist sentiment online, the real impact is economic and global. Experts warn that if the tit-for-tat continues, it could shave billions off global GDP. The IMF has already issued a note of concern about how the trade war could fuel inflation and stifle growth. President Biden, though no longer in office, continues to argue from the sidelines that diplomacy, not tariffs, is the answer. Trump, however, remains defiant, insisting that these actions are about protecting American jobs and tech dominance. Drop your thoughts in the comments, and don't forget like and subscribe for the latest updates on global politics.